All right, let's talk about money. Have you ever really thought about why a dollar isn't just a dollar, no matter where you are in the world? Today, we're going to break down exactly what makes different currencies have totally different values.
I mean, it can feel completely random, right? You look at an exchange rate board and it's just this jumble of numbers. Why? What makes one currency worth so much more or so much less than another? Well, to figure out today's system, we actually have to go back in time because the answer has changed a lot in the last 50 years or so.
So to understand how things work now, we've got to take a trip back to when the rules of the game were way simpler. We're talking about the age of gold. For a very long time, money wasn't just a piece of paper. It was basically a promise. The system was called the gold standard. And what that meant was that every dollar or pound or franc was basically a claim ticket for a real physical amount of gold that a country had locked away in a vault. Its value was something you could literally touch.
And this created a really hard limit. A government couldn't just fire up the printing presses whenever it wanted to. Nope. If you wanted to create more money, you first had to get more gold. It was a system that kept currency values pretty stable because they were all anchored to a real physical thing.
But then, it all changed. This timeline right here shows you the breaking point. In 1971, the US officially said, "We're done." They cut the link between the US dollar and gold. And because the dollar was so important for the whole world's economy, that move pretty much ended the gold standard for everyone. A completely new era had begun.
Okay, so with gold out of the picture, we needed a new way to figure out what money was worth. And the world basically landed on the same fundamental principle that decides the price of, well, almost everything: supply and demand.
This really nails the huge shift that happened. We moved from a system based on a tangible thing, gold, to one based on something you can't see at all, global perception. It's not about what's physically sitting in a vault anymore. It's all about how much the world wants your currency.
That's it, right there. This quote gets right to the heart of it. If a whole bunch of people and countries want to get their hands on a particular currency, its price, what we call the exchange rate, goes up. And if people start losing interest, the value drops. It's that simple at its core, but what drives that demand? That's where it gets really interesting. Let's just take the US dollar and the Japanese yen as an example. One single US dollar can buy you well over 100 yen. Now, that's not because the US economy is 100 times better or anything like that. It's simply because the global demand to hold and use US dollars is way higher than it is for yen.
So this obviously leads to the next big question. If a strong currency is all about high demand, what can a country actually do to make its money more attractive to everybody else?
This is the multi-trillion-dollar question, isn't it? Countries are basically in a constant competition to make their currency the one that everyone wants to own. So let's take a look at the playbook they use.
Okay, here are three of the biggest drivers. First, being the reserve currency for a giant global commodity like oil. This means everyone needs your currency to buy and sell oil, which creates this constant, massive demand. Second, low inflation is huge. If your money actually holds its value instead of losing its buying power, people see it as a safe place to park their wealth. And third, you want to attract foreign investment. When a company from another country decides to build a factory, they have to buy your local currency to pay for everything. And that, you guessed it, boosts demand.
This chart gives you a pretty clear picture of that demand gap we were talking about. Things like the dollar, being the world's reserve currency, create this enormous, constant demand that just isn't there for the yen on the same scale. And that directly affects how they're valued against each other.
So really, it all boils down to this one simple formula. Pretty much every major economic decision a country makes is, in some way, trying to tip this equation in its favor.
But hang on, there is one more crucial piece to this whole puzzle. It's the foundation that everything else is built on, and it can make or break a currency no matter what else is going on. And that thing is stability.
Yeah, you could have super low inflation and roll out the red carpet for investors, but if your country is seen as unstable, if people think things might fall apart, none of it matters. Trust is the invisible bedrock of all modern currency, and without it, the whole thing just crumbles.
And you can see how it happens. It's this dangerous downward spiral. Some kind of instability erupts. That shatters confidence, causing investors to run for the exits. They start selling off the currency, trying to move their money somewhere safer. This mass exodus makes demand totally crater, and boom, the currency's value just collapses.
So we've journeyed from a world where money was backed by gold to a world where it's backed by something way more fragile: trust and confidence. It's a system built on perception and strategy. And that leaves us with maybe the single most important question in the entire global economy. What happens when that trust is broken?